There's one type of strategy that if you use it during a down move, a stock market crash, you can really benefit from it, and not only from the stock price movement. And I'm going to explain what I mean by this. It's a strategy that I like to use for different reasons, and there are different reasons, for example, in terms of volatility, time decay, and I'm of course going to explain all of this with examples so it's completely clear for you. So if there's a down move again or a stock market crash, you know that you can use this strategy and why it would work so well. So without waiting, let's get into the strategy. I don't want to wait any longer. So this strategy is the put debit spread strategy. If you've been into options, you must have heard about debit spread. So this one is the put debit spread strategy, meaning that you have a bearish assumption on the stock. And you see that it would match what I just said before, meaning that this strategy would be, of course, used in a down move, in a bear market, because you take advantage of down move. You essentially short delta. However, this is not the only reason why this strategy can be such a good tool, such a good medium to express your bearish view on the market, because if it was only about the bearish exposure that the put debit spread strategy gives you, you could choose another strategy. You don't need to use the put debit spread strategy. You could use, for example, a call credit spread so as to express your bearish point of view. But here we're getting interested in the put debit spread strategy for other reasons other than just the short delta. But for those who don't know what the put debit spread strategy is in the first place, let's do a small recap so it's clear. The put debit spread strategy consists in buying a put and selling a put at a lower strike. That's going to create a trade where you're going to pay a net debit. That's why we said that it's a put debit spread, because you're paying a debit. And what you hope when paying that debit is that the price of the spread is going to increase so you can sell it back at a higher price and make a profit overall. So let me give you an example in Tastyworks so it's completely clear. So right now I'm in the Tastyworks platform and I've chosen the SPY, the S&P 500 ETF. I'm in the May expiration and what I have in front of me is the option chain. So if we were wanted to create, for example, a put debit spread, as I said, then we would buy a put and sell a put at a lower strike. So in our case, for example, I could, for example, buy the 402 strike, and let's say that I would sell the 399 strike. You see that I would have a max profit of around $186. I would have a max loss of $114. You see that I would then have a buying power effect of $114 because the debit that I'm paying for debit spread is the max loss that I could have on the trade, meaning that maximum on that trade I can lose $114 and maximum I can make $186 of profit. So this is really for the mechanics of the put debit spread, how to create a simple put debit spread. I'm going to put an example on the side for now. You'll see that we will come back to that example later and I'll explain why I've chosen the strikes, because you see that it's going to get really interesting down the line. But in the meantime, I'd like to talk about something that is very important to understand: the implied volatility. For those who are not familiar about the implied volatility, or called IV, is representing essentially the demand for options. The higher the demand for a certain option, the more expensive that option will become and the higher the implied volatility will be. That's how it works. If the option prices get expensive because of the demand increasing, then you'll have the implied volatility that is also going to increase, and vice versa. If the options are getting cheaper, then the implied volatility will also go lower. And that's completely normal. That's how it works in the implied volatility. That's how it works with the option prices. It really works in tandem, meaning that if one goes up, then the other one goes up too, and if option prices get cheaper, then the implied volatility will also go down too. And you really need to understand that the implied volatility refers to the demand of options, meaning that, for example, let's imagine that you think that there is going to be a crash that is going to happen. Well, if you have a portfolio of stocks, one way that you could hedge yourself against a crash is to buy, for example, put options on the SPY. Why would you do this? Because if you buy a put option on the SPY, then it means that if the SPY crashes, your put option is going to take a lot of value and you're going to make a big profit on that position, which is going to help offset the potential losses that you could experience on your long stocks. That's why, for example, people during a crash would buy a lot of puts at once, because they see that now the market is crashing, so they want to offset potential losses that they could experience on their portfolio of stocks, for example. But remember what I said just before. I said that, for example, if there is more demand for a certain certain option, then the price of those same options is going to increase, it's going to get more expensive. And we know that the implied volatility is derived from option prices, and if the option prices are getting more expensive, then it's the implied volatility that will also get higher, and vice versa. So it means that, for example, let's say that there is a crash that is going to happen, or it's already starting, then a lot of people are going to be willing to buy put options, for example, on the SPY. So theoretically, it means that if there are more and more people willing to buy put options on the SPY, it means that those same put options are going to get more expensive. And because they get more expensive, it means that the implied volatility will also get higher. I have on that chart what we call the VIX, or the fear index. It represents the implied volatility for the S&P 500. And what we see, I've taken, for example, the chart for the March 2020, when there has been the COVID crash. What you can see is that the implied volatility for the S&P 500 shot up to 85, the VIX top 85 at its maximum, meaning that the option prices were getting a lot more expensive. That's just because people were buying a lot of puts, pushing put prices higher, making them more expensive, and so pushing the implied volatility, the VIX, higher too. But why does it matter? Because I was talking about put debit spread just before, and now I'm talking about how a demand can influence option prices and then also make the implied volatility go higher. What's the link between the two? Well, the link between the put debit spread and, for example, the implied volatility is that when you, for example, purchase a put debit spread, you're going to be what we call long VIGA. VIGA being the Greek letter that refers to the implied volatility. And it means that if you're long VIGA, you're long implied volatility. Meaning that if the implied volatility increases, then it means that the option prices are going to get more expensive too. That's what we were talking about before. But remember that I said that when you're buying a put debit spread, you're hoping for the price of that spread to increase. So it means that if you have the options that are going to increase because people are more and more scared of a potential crash, then it means that your spread is also going to increase in price, which is a good thing for you because you want your spread price to increase so you can make a profit with the difference and sell it at a higher price. So it means that, for example, if you're buying a put debit spread and a crash happens, other than the fact that yes, you'll make money because the stock market is going down overall, you'll also make money because the implied volatility will be going higher and higher. Because people are going to be more and more scared, they're going to start buying more and more put options so as to hedge their portfolio of stocks. And because of that, because it's going to make option prices get more and more expensive, it's going to help you make even more money on your put debit spreads. And that's something that happens over and over and over. Usually when the stock market is going down, and especially if it goes down very quickly, you're going to see the implied volatility overall for most of the stocks that are going down at that speed is going to go high very quickly too. And as I said, the reason is that people are getting scared. So what do? They buy put options so as to make sure that they're not going to get hurt too much if the stock continues to go down. And what happens? Well, it pushes option prices higher, and so the implied volatility higher too, and which is going to benefit you if you have a put debit spread on, because you're not going to only make money on the fact that the stock is going down, but you're also going to make money just because the demand for those options are also increasing, pushing the implied volatility higher too. And if it's not completely clear yet, which I can understand, there is no problem, there is a very good example that I'm sure you probably experienced before. Have you ever bought an option, either it's a call or a put, the stock went in your direction, in the direction that you wanted it to go, but you still lost money and didn't know why? So it could be because of the time decay, but it could also be because, for example, the implied volatility went against you. For example, if you bought a put debit spread or a call debit spread, and the option prices, the demand for those options went down, so it pushed option prices lower, making them cheaper, and so the implied volatility also went lower too, which in the end made you lose money because you want your spread price to increase when you buy a debit spread. So if option prices are getting cheaper, then it's making you lose money. That's logic. And that's exactly the same in the opposite. If you, for example, sold a credit spread and you see that the implied volatility is going up because people are more and more scared of, for example, a potential stock market crash, then you're going to lose money because the implied volatility is going higher. On the opposite, if you sold a call credit spread or a put credit spread, then if the implied volatility is going down, it's going to benefit you because you're going to make money from the option prices going cheaper, getting cheaper. So that's one very big advantage of the put debit spread. If you buy a put debit spread during a down move, for example, if you think that the stock market is going down, you're going to have a very big winner because not only you're going to earn money because because the stock is going to go down, but you're also going to earn money because the implied volatility is going up. And if you think that it only represents a small part of your profit, meaning that the majority of the profits will probably come from the stock going down, it's probably true that you'll have profit from the stock going down, but the demand itself for options is going to play also a major role. And if you don't believe me, which is completely fine, look at the impact of demand on options after an earning announcement with the very famous IV crush. That shows how powerful is the demand and what is its effect on option prices. That's not the only benefit of the put debit spread. Yes, you can make money with the put debit spread with the stock going down, with the implied volatility going up, but there is something that is even more interesting. Usually when you buy an option, there's something that we call the time decay. The time decay is something that happens for all options, and that refers to the fact that options are losing a tiny bit of value every day. And the closer we get to expiration, the bigger that amount. That's the time decay. And in the Greek letters, that's referred as theta. And usually when you buy options, you're going to have the time decay working against you. Because if you buy an option, as I said, you want the option price to increase so you can make a profit. You want it to increase so you can sell it at a high price. Nothing new here. So if you buy an option, you're going to have the time decay working against you because it's making the option price lose value day after day after day. And the closer you get to expiration, the bigger the amount. So it's going to work against you if you buy options. And on the opposite, if you sell, for example, on credit spreads, then it's going to work in your favor because you want the option price to decrease. So the time decay is exactly doing this. It's going to help you. However, there is a way to buy debit spreads and still earn from the time decay and still having an overall time decay that is positive and that is making you earn money even though you bought options. How does that work? Well, it's quite simple. Usually when someone says that it's quite simple, it's absolutely not simple, but whatever. I said that when you buy a put debit spread, you're going to buy a put and sell a put at a lower strike. And to be able to earn money from the time decay, even though you bought a put debit spread, you need to buy less extrinsic value than what you are selling. In other words, you need to sell more extrinsic value than what you're buying. And I'm going to go into TastyWorks and show you with some real examples because otherwise it's not going to be clear. So let's jump right into it. I took back the example of the SPY and the spread that we were talking about at the beginning of this video. So I was saying that I would buy, for example, the 402 strike and I would sell the 399 strike, which would create a put debit spread as I said. So the goal here is to create a put debit spread that is going to make me earn money from the time decay, even though I buy options. And to do that, as I said, you need to be able to buy less extrinsic value than what you are selling. And it makes sense because if you sell more extrinsic value than what you just bought, it means that the option that you sold is going to earn more from the time decay than what you are losing from the option that you bought because the option that you sold has more extrinsic value. And the time decay works on the extrinsic value. So if you bought less extrinsic value than what you sold, it means that you're going to lose less money than what you're going to earn on your short option. It means that the time decay is going to be bigger and is going to make you earn money on your short options and lose money on your long option. But overall, you're still going to be profitable because you sold more extrinsic value than what you have bought. So for the sake of the example, I've, for example, chosen to buy the 403 strike and to sell the 400 strike. And what do we see that is actually quite interesting? Do you see what's within the yellow rectangle? That's written EXT for extrinsic value. That refers to extrinsic value. And you can see that there is 62, meaning that there is $62 worth of extrinsic value. And what's very interesting is that you see that if I, for example, move my short strike, you see that this number is going to decrease if I move it to lower strikes. And the reason is that the lower the strike, the less extrinsic value there is. So it means that if I move my short option at lower strikes, I'm going to sell less and less extrinsic value and so earn less and less money from the time decay. And you can see that with that column that you can see here within this yellow rectangle, you see that I've put the extrinsic value for each and every single strike. So what you can see is that, for example, when you are at the 400 strike, if you were selling the 400 strike, you would sell almost $8 worth of extrinsic value. But you can see that the lower strike you go, the less extrinsic value that you're saying. And remember what I was saying, you need to be able to sell more extrinsic value than what you're buying so as to create a put debit spread where you're earning money from the time decay. So in our case, it would be better, for example, to move the short strike for example, around the 400 strike, where we sell the most extrinsic value possible without being in the money. And for the long option, we need to be able to buy less extrinsic value than what we have sold previously. So in our case, we need to buy a put that has less extrinsic value than our short option. So we need to buy a put that has less extrinsic value than $7.99. And for example, you see that if I move my long strike to the 402 strike, you see that I'm going to buy $7.95 worth of extrinsic value, and you see that I'm selling $7.99 of extrinsic value. So I'm positive of just $4 of extrinsic value, which is really not much. And you can see here theta, which refers to the time decay, how much money you're going to earn per day or lose per day. You see here that it's a positive number, meaning that as there is a positive extrinsic value, $4 of extrinsic value, then I'm going to earn 21 cents per day. So you see that it's really not much. It's not going to make me a millionaire or whatever yet, but if you go, for example, for higher strike with your long option, then you're going to pay less extrinsic value and so make more from the time decay. For example, I've chosen the 407 strikes, so obviously all of this is for the sake of the example so you understand. I'm not saying that this is a put debit spread that you should absolutely trade, but this is really for the sake of the example. And you see that with the 407 strike, you're buying $5.35 worth of extrinsic value and you're selling $7.99, which makes a positive of $260 worth of extrinsic value. The difference is $2.64, but as one contract controls 100 shares, it means that you're selling $264 worth of extrinsic value. And if you make the subtraction between $7.99 and $5.35, you're going to find $2.64. That's why it's written 264, because it's multiplied by 100, because there are 100 shares in one option contract. And you see that now my theta, my time decay per day, is going to be of $1. I'm going to earn $1. And if the trade moves in my favor, it means that I'm going to earn more and more. And if the stock is going down in that setup, let's say that I buy that put debit spread and then the stock is going down, then I'm actually going to be positive time decay, meaning that I'm going to earn money from the time decay on a daily basis, because the amount of extrinsic value that I have sold is bigger than the amount of extrinsic value that I will have bought. So it's going to make me earn money from the time decay even though I have bought a put debit spread. And that's something that is really powerful. I cannot say it enough, because usually what's being said about debit spread is that because you're buying options, meaning that you're buying and you're paying a debit overall, then the time decay is working against you and it's making you lose money on a daily basis, and it's not necessarily a good strategy. However, you see with that trick that if you focus on selling more extrinsic value than what you're buying, then you end up buying a debit spread that is going to make you earn money from the time decay, even though you paid a debit in at first, meaning that you paid a debit to open that position. It's going to still make you earn money from the time decay. How cool is that, honestly? That's why I'm saying that this is really a great strategy. For example, if you see that there is a down move that is happening, because what's gonna happen is that you're going to bet that the stock is going down, and if it goes down, then you're going to obviously earn money. But you're not going to earn money just from the stock going down. You're also going to earn money because the implied volatility is going to rise, meaning that the demand for those options is going to increase, pushing option prices higher. So you're going to also make money that way. And on top of that, you saw that you could also earn money from the time decay if you actually buy less extrinsic value than what you're selling, because the time decay is working in your favor when you sell options and against you when you're buying options. So if you sell an option that has more extrinsic value, and as the time decay is only working on the extrinsic value, then it means that you're going to earn money from that. And you saw with our SPY example that it's actually the case. You could buy that put debit spread and earn money from the time decay. So quite cool. That's why I said that it's an amazing strategy to use, for example, in the bear market, because usually in bear markets you tend to see the implied volatility going up because people are getting scared that the stock could go down even more. And in that case, they want to hedge themselves, they want to hedge their long positions by buying puts, which is going to benefit you if you have bought a put debit spread. It's going to push the price higher and so make you earn money. I hope you enjoyed this video about the put debit spread. This is quite a different video than usual because I wanted to be more into the technicalities, but this is so important to understand because this is something that is quite misunderstood about debit spreads in general. You can buy a debit spread and still, for example, earn money from the time decay. I think it's the most complicated thing to understand, understand, because it's about extrinsic value and you need to understand that the time decay is working only on the extrinsic value. That's why I wanted to make this video, because this is, I think, in my opinion at least, super important to understand this type of mechanics and how you can benefit from it. For example, paying a debit for a put debit spread and still earn money from the time decay. That's really cool. If you have any questions, just don't hesitate to comment it below. I'll be happy to answer any questions that you might have. If you found this video interesting, you learned something, for example, about the time decay or the implied volatility, the only thing that I would ask would be to leave a like and to subscribe to my channel. That's really the only thing that I would like, and that's the best support you can give me if you want to support my channel. So thank you very much if you do. Please make good and informed decisions as always. I'll see you in the next video, and in the meantime, I wish you all the best.